Hi friends, I am Viral Shah, Senior Instructor and Head of Investing Education with Sher Khan Education. The COVID-19 pandemic brought several sectors such as pharma, specialty chemicals and electronics manufacturing sectors into the limelight. Many stocks within these sectors have witnessed big opportunities for growth owing to the structural change in procurement strategy from China to other East Asian countries. One such sector was the specialty chemical sector, where many Indian companies are vying for a larger share in the global market share. However, the recent run-up in crude prices has stalled the rally of these companies, and most of them have seen a decent correction in their stock prices. Such a scenario allows us to invest in specialty chemical stocks that are available at a reasonably good valuation. One such stock that fits the bill is Aarti Industries Limited. Aarti Industries is expected to grow its revenue by a CAGR of 22% over the next 2 years with an EBITDA margin in the range of 25 to 30%. Despite substantial capex, the debt is expected to remain stable on the back of money raised through QIP, bare termination fees to be received at the end of FY23, healthy cash flows, and some incremental debt of Rs 6 to 8 billion. At the current market price of Rs 837, the stock trades at 34 times and 28 times FY23 and FY24 estimated earnings and is at an average valuation on the PE band. Strong growth in the pharma business, the demerger of the pharma business, and the growth outlook on the back of capex remains strong. We have a positive view on the stock, and the investors with a long-term investment horizon could enter the stock at Rs 750 levels based on technical levels. Now let's look at a detailed understanding of Aarti Industries. Aarti Industries is a specialty chemicals and pharma manufacturer. Its specialty chemicals business includes a value chain of benzene, toluene, and sulfuric acid. Besides these, it also manufactures chemicals such as single superphosphate, export-grade calcium chloride granules, fuel additives, and phthalates. Its pharma business includes API intermediates, and xanthine derivatives. The specialty chemicals business is vertically integrated and has enabled the company to keep adding new chemistries by entering downstream products. The continuous addition of products has made Aarti Industries one of the top 5 producers globally in 75% of its products and a leader in the Indian market. It also ranks among the largest players globally across various processes like chlorination, nitration, and hydrogenation. The pharma API business is backward integrated for most of the intermediates, and the company exports 60% of its products to regulated markets. Aarti Industries is a preferred supplier for global customers, and exports contribute around 50% to its overall revenues. The company boasts of a strong management, with the first generation being technocrats who develop a niche business. The second generation has come in and has been responsible for turning around the pharma business. It has also put in place professional management. Let me highlight the investment thesis for Aarti Industries now. Thesis number 1 is a key beneficiary of China Plus One strategy. Aarti competes with China in almost 40% of its product portfolio and is getting increasingly competitive given China's rising labor cost, rupee depreciation versus renminbi, and its cost of compliance with environmental regulations. Due to its complete backward integration in specialty chemicals, Aarti has no dependence on imports for raw material supply. Aarti is targeting those products where India is highly dependent on imports and where it has very little domestic competition. This has opened a lot of opportunities in the pharma segment, where Aarti is supplying API and its intermediates to domestic suppliers. Thesis number 2. It has integrated operations and access to basic raw materials. Aarti Industries has an excellent R&D base and integrated operations which help it to offer more than 125 products at cost competitive rates to customers across multiple industries. Aarti has been able to incubate the toluene, derivatives and contract manufacturing business, owing to its ability to handle complex chemistries and growing downstream products, establish a diverse customer base and global distribution network, and gain a foothold for the availability of basic raw materials. Thesis number 3. The outlook for the benzene market remains robust. Synthetic polymers such as polyester, polystyrene, as well as end-user industries such as textiles, packaging, building and construction, electricals, and electronics are expected to drive the demand for the benzene market to 57 to 58 million tons by 2025 from 51 million tons in 2020. Aarti Industries will be the key beneficiary of this growth as it is one of the largest players in benzene and its derivatives in India. Thesis number 4. Aarti has aggressive capex plans. Aarti has already doubled its capital expenditure from FY19 to FY21 and it further plans to double the capital expenditure by FY25. The company has been investing in downstream derivatives of benzene and toluene, contract manufacturing, and expanding its pharma capacities. It has chalked out a capex plan of Rs 15 billion, largely for 2 long-term contract manufacturing projects. Additionally, it will incur Rs 25 to 30 billion worth of capex targeted at new chemistries and value-added products. Existing capex efforts are expected to increase nitrotoluene capacities, enter into chlorotoluene, add new toluene and benzene derivative lines to business, and expand existing benzene and derivative volumes. The expansion in the pharma business will improve margins owing to operating leverage and backward integration. Contract manufacturing revenues will be catalyzed by QSHE compliance and new R&D team will assist its superior product capabilities. Thesis number 5. Demerger of its pharma business. The demerger of the pharma business is likely to be completed by Q2 of FY23 and given a robust outlook, the management remains upbeat on the growth in pharma business over the medium term. The demerger will provide value unlocking potential for shareholders. Given all these theses, Aarti Industries is expected to grow its revenue by a CAGR of 22% over the next 2 years with an EBITDA margin in the range of 25 to 30% on the back of rising capacity utilization, higher volumes, and a possible correction in inflation, which can not only improve raw material costs but also improve the outlook of end user industries such as textiles and FMCG. Despite substantial capex, the debt is expected to remain stable on the back of money raised through QIP, Bayer termination fees to be received at the end of FY23, healthy cash flows, and some incremental debt of Rs 6 to 8 billion. Its return on equity ratio is expected to be in the range of 15%. A possible resolution of 2 observations from US FDA audit of the Dombivli API unit in June 2022 will be addressed soon, and this could be a key trigger. At the current market price of 837, the stock trades at 34 times and 28 times FY23 and FY24 estimated earnings and is trading at an average valuation on the PE band. Strong growth in the pharma business, the demerger of the pharma business, and growth outlook on the back of capex remains strong. We have a positive view on the stock, and investors with a long-term investment horizon could enter the stock at Rs 750 levels based on technical levels. This is Viral Shah signing off. Happy investing. This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing.